welcome to the Monday edition of Dividend Cafe. We had a reasonably normal Dividend Cafe for you today because we're just covering a few different things in every category. Although I suppose there may be a few important things to say about the Fed and based on the Jackson Hole time from Friday. Let me start just by getting the market stuff for the day out of the way. Markets were down 349 points. The Dow, which is 0.75%, opened down about 100 points and then just kind of went slowly but surely down further throughout the day. This, of course, comes off of the huge rally day of Friday after the Jackson Hole speech that Chairman Powell gave. So I'm going to talk about that in a moment. But I just want to get kind of the data out of the way. Dow down 0.75 point, S&P down almost 0.5%, Nasdaq down almost 0.25%. And when you look at the Friday rally, 91% of companies that are listed on the New York Stock Exchange were up. And that's only happened 5 times in 2 years, that level of breadth. And then the advanced decline line in the Russell 3000, 14 advancers for every 1 decliner. So you had really a pretty noteworthy day on Friday in terms of breadth. 80% of companies have seen positive revisions the last 3 months in their forward earnings estimates. Now, this is more sentiment oriented than fundamental. People start feeling better about things and then they start revising higher the estimates. This is not about revisions going higher from actual earnings, but it is still generally a decently reliable forward indicator. And the fact that it's happened with 80% of companies speaks to this breadth argument I'm making, that there has been a reasonably encouraging spread of where things are going well in markets. Has not changed the concentration and the top heaviness, but there's been more participation across different sectors of the market. The 10-year bond yield today closed at 4.28%, which was up 2 basis points on the day. Of course, the entire bond market rallied violently. Bond yields fell across all spots on the yield curve on Friday, but today, pretty modest movement. Top performing sector today was communication services, was up 44 basis points. I think the only other positive sector today was energy, which is up about 0.25 point. And then the worst performing sector today was consumer staples, which was down 1.6%. The only other anecdotal thing I think I'll mention is that Shanghai's stock market is making a 10-year high. So a lot of good things happening for China. Okay, in terms of the public policy side, the announcement sort of started to come, or it came that it was coming last week, that the United States federal government has taken a 10% equity interest in Intel, and there's a link to this announcement in the Dividend Cafe today. The government also in this deal that then finally got kind of officially announced over the weekend is getting warrants to buy up to an additional 5% of the company at $20 a share, significantly below current market price. Then this morning, National Economic Council Director Kevin Hassett said that the government plans to do a lot more deals like this and is essentially wanting to create their own sovereign wealth fund. Of course, unlike a lot of sovereign wealth funds, this would be deficit funded. They'd be using borrowed money to buy stakes in other companies. But he specifically referenced the government wanting to do this with other companies in multiple or across different industries. I'm going to write about this at length in the Friday Dividend Cafe. I had another topic in mind going into Labor Day, and I changed my mind this morning and decided I picked my topic for the week already. But I'm going to have to leave you in suspense beyond that, because if I start talking about it right now, I promise you I'm not going to stop. Other public policy news is that President Trump announced the U.S. is looking to impose, and he didn't say a number, significant tariffs on imported furniture. And said those will start in the next 50 days. So I'm not sure if they're saying that's the furniture thing is related to national security or not. but that's the latest sectoral tariff we're after is couches coming in from other places. The trade deficit in the first 6 months of the year increased by 38% over what it was at the midpoint of 2024. So midway of 25, trade deficit higher by 38% versus where it was the midpoint of 24. That's a movement from $421 billion in the first half of the year in 2024 to $583 billion in the first half of 25. Now, it is, first of all, my opinion, as I've expressed several times in different contexts, that the tariff policies of the administration won't ultimately do anything to reduce the trade deficit, but that they don't need to because there's nothing wrong with the trade deficit. Now, that said, you could say, well, the trade deficit actually went up 38% year over year. Doesn't that kind of pour water on the idea that they're going to do this? And I would say that no, actually, the trade deficits in this case skyrocketed higher because of front-running imports, whereby companies were accelerating their import orders to try and get in front of the tariff. So I wouldn't be surprised to see that come lower, but I would not say that I care either. On the housing front, a number of data points I want to get into here that came out in the last several days. First, the NHB housing index, the home builders, 68% of home builders reported using incentives to get a transaction done last quarter. That's the highest level since May of 2020 when the world was shut down. New building permits dropped for the fourth month in a row. So while new multifamily starts have had a good rebound, the leading indicator that permits are, in terms of permits being pulled for new single-family construction, continues to be very depressed. Now, existing home sales increased by 2% in July, and they saw median prices drop. That may have helped to get a little bit additional volume. But the annual pace of home sales is over 1 million homes less than it was pre-COVID. It's over 2.5 million homes less than it was post-COVID. In terms of new home sales, so we get the data for existing homes, what they've bought and sold and whatnot, and then brand new construction selling to a buyer for the first time. The volume of new home sales was down 0.6% month over month. And the average price of a new home sold is down 5% versus a year ago. That's the mean. And then the median is actually down 5.9% from a year ago. Now, according to Redfin, July was the slowest sales month in over a decade. The average home is now on the market for 43 days. That's the longest in over 10 years. Supply is up to 5-year highs. And this is the stat that grabbed me. Only 29% of homes went above their asking price. That's the lowest number selling for over asking price in over 6 years. So still a pretty unanimous verdict, unanimous set of data in the housing world of some slowing, troubled circumstances. So I mentioned the Fed, Jay Powell's speech in Jackson Hole. Clear as could be, a rate cut is coming in September. Futures, though, were already over 70% probability for a rate cut in September. And then, of course, that basically went well up into the 90s. It's unlikely to me that markets rallied just on the shocking news that was already over 70% priced in that the Fed would be cutting in September. I think more likely it removed some hedges, removed some kind of people having to put trades on, allowing for unexpected results, and then expectations for marginally more accommodative monetary policy into next year. In other words, markets trading on what they're thinking this might mean for December, January, et cetera, versus just what it means here in a few weeks. The line from his speech that I think has been repeated the most: with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. That right there kind of captured the narrative shift. I won't get into a lot on this issue of Fed Governor Lisa Cook. That is apparently the president's threatening to fire her, and she's facing investigation about claiming on 2 different mortgage applications primary residence. The reason I'm even bringing it up at all is just simply because of the fact that it would mean if she were replaced, either because she resigns or is terminated, and that were to hold up in court, all of which are big ifs, that 4 of the 7 seats of the Board of Governors would be Trump appointees. And I'm not including in that Jerome Powell. He was actually a Trump appointee too, but they've obviously kind of gone, adversarial. But why does that matter when the Board of Governors is not the same as the Federal Open Market Committee that does the voting, filled up of different Reserve Bank presidents? Because the Board of Governors can fire Reserve Bank presidents at will. The president can only fire for cause. So I don't know that this would happen. It has certainly never happened that Board of Governors has fired Reserve Bank presidents for no reason. But there is theoretically a backdoor way that a Trump-controlled body, or at least a Trump-appointed body, the Board of Governors, could move different people in and out of positions at their sole discretion. I still would be skeptical that would happen. There's a link, by the way, in Dividend Cafe today to the Atlanta Fed in a paper that they've recently written, open to the possibility of a tariff-induced elevation of prices being sticky. And there's a lot in the paper that's interesting and noteworthy. So crude oil closed at $64.73, up about 1.68% on the day. I'll point out, too, that last week, midstream energy, the midstream energy sector we follow so closely here at the Bahnsen Group, was up about 1%, and energy stocks were the top-performing sector of the week. Somebody had asked in the Ask TBG, and I definitely recommend you go to the homepage, dividendcafe.com, and look at the Ask TBG for the written answer to the question. But someone had asked if our concern about the administration taking equity stakes in companies, newness around sustained tariff policies and what it could mean to economic health or financial markets, liquidity, all topics I've written about recently, if it would cause us to impact portfolio strategy, change things entirely in what we're doing. And I just want to read my answer to give those who only listen to the podcast or video a little take on this, because it's very important. It was a great question. There is newness across policy and economic conditions right now, no doubt. But various economic vulnerabilities, volatilities, and even policy abuses are not at all new. In fact, they're the norm. The specifics twist and turn, yes, but the basic underlying reality of some economic and policy vulnerability is incredibly common. So with that said, one of the basic profundities of dividend growth investing is that it is reasonably agnostic about economic vulnerability and policy madness. Particular companies may have particular impacts we have to manage for and always have, but the general thesis is to replace the risk and reward of macro with the risk and reward of individual companies sustainably growing their dividends. The macro things I address are not going to change our investment philosophy, and your age and stage benefits from our approach, meaning those, near the reason for the context is someone who asked the question was nearing or entering retirement. So I think that to pick up where I left off, we would not be abandoning dividend growth investing over the headlines of the day here, and in fact believe that they are a feature, not a bug. All right, so you have Nvidia releasing earnings results Wednesday after market. The first time ever a company that makes up over 8% of the S&P 500 is releasing earnings. And I mentioned the Dividend Cafe on Friday is going to cover this talk of government equity ownership in private companies. With that said, feel free to check out dividendcafe.com. There are links to different things and lots of fun stuff to check out as always. But in the meantime, reach out with questions you have for us, comments you have for us anytime. Questions at thebahnsen.com. Thank you for listening, thank you for watching, and thank you for reading the Dividend Cafe.